Hello everyone and welcome to the third part of the webinar series on using technical analysis from a trader's perspective. This is your host Prasenjit Biswas and today I will be talking about indicators. In the previous two webinars, we discussed about trend lines and how you can use them to identify chart patterns. And in terms of the flow of the presentation today, we will be looking at the topics that we have covered already, and then I will be talking about the two main indicators that I look at while recommending trades, and that will be followed by some practical examples too as well. So let's just begin with the recap. So in the first webinar, we have seen how trend lines are to be drawn and what are the important things that are to be kept in mind in terms of the number of points and the length and the spacing and the angle of the trend line. And we also discussed about the practical aspect of drawing a trend line when it comes to the real life charts. The points that you connect to draw a trend line are generally not ideally aligned, and that's what makes things slightly difficult. And we discussed about the theories that I use and how we can deal with these practical cases where the points are not properly aligned. And then we also discussed about the various types of patterns in the webinar 2. We talked about channels, triangles, wedges, and then flags and pennants, and then double bottoms and tops, and head and shoulders, right? So we are quite familiar with all these patterns and how they are to be traded and what is the criteria for setting up the target and what kind of stop loss generally do I use. So all this was in isolation, and I was not using any kind of indicator along with this, and I was only using the price action to identify the trade setups. And today we will be further looking into the signaling part of from indicators. And in the previous videos, of course, we discussed about the signaling parts from a trend line perspective as well. So we know that during in case of a trend line, either you can take a trade at the support or you can go short below the support line. And if you are doing or kind of a momentum trade, then you are actually the one who goes short below the trend line and buys above the resistance line. So that is momentum trading, and the other way around is the mean reversion trading. So we discussed all of that, and then when we combine the concepts of indicators, which we are going to discuss today, the signaling techniques can become more potent, and there could be these indicators could actually be used like a filter. So what is basically a technical indicator? So at the definition level, if you ask me, then I would say that they are just an outcome of the mathematical number juggling, and in general they are based on price action and typically the historic price volume data. So they happen to be some kind of a heuristic in nature, and of course a lot of technical analysts use them to predict the future price trends and analyze the prevailing structure of the asset in terms of its momentum and the trend. The other thing is that those who are doing system trading, they would appreciate the fact that they are very easily compatible to system trading, and they can be implemented into a computer code. So the very fact that they are, most of the cases, they are like formula based, and they can be very easily measured and can be coded into a program. So that is what makes them very interesting. So if you look at the broad categories, then to me, I would say that there are essentially 4 types of indicators in terms of the categories, and they are like price, volume, breadth, and sentiment. So in terms of the price category, moving average is one of the most common indicators that is being used widely across the world, and a few derivatives of the moving averages like the MACD and the MACD histogram are also quite frequently used. And then we have the ADX indicator, which is again used to determine the strength of the trend. And of course, you have oscillators like RSI and stochastics. So this is in terms of the price indicators, and there are of course a lot of indicators which I'm not mentioning here, but then there are a whole host of indicators. So similarly with the category of volume, there is unbalanced volume, check in money flow, accumulation distribution. When you look at the breadth indicators, there are like few indicators like advanced decline ratio, arms index, and then you have the high-low index. Typically, these breadth indicators are not used at a, or cannot be used at a security level or at an individual stock level, because they are designed in a way which measures the entire market strength, and they are designed based on the entire market data. So they are kind of holistic in nature and give you a broad idea about what is happening across the market at a market-wide level. And then you have the sentiment indicators, which are very interesting. And some of the derivative data can be used to ascertain the underlying tone of the market, like PCR or an open interest buildup in certain stocks can give you an idea about what is happening from a short-term perspective. Similarly, the option implied volatility, which comes from the Black-Scholes model, gives us an idea about the level of fearfulness in the market and the anxiety level of the market. And of course, the social media, I mean, media as an input, like a lot of tweets and what is going across in the television and the print media, that also talks a lot about the underlying sentiment around a particular stock or the market. So now, of course, as I said, that there are, I mean, very, I mean, a huge number of indicators that are available in the market. And if you buy or purchase a professional software, you would find a list of indicators that that is like almost endless. So the point is that do you really need to look at all the indicators? Does it make your life easy, or what is the benefit of using so many indicators? So the point here I'm trying to make is that it is basically the category which is important. So if you're using an indicator from a particular category, you don't have to use a similar indicator from the same category. Say, for example, if I'm using a moving average, then an MACD would not give me an additional benefit. And now this is very important for you to understand, that if you are like looking at a price indicator, then probably your MACD and moving average will give you a very similar kind of an indication, or even an RSI. It would never be a situation where the stock is going up and the moving averages are going up and your RSI is like extremely oversold. You would not see that. So in case the stock is making an all-time high, of course your RSI levels will be at a higher level only. And similarly, in case of any other category, like if you're using a volume indicator, then if there is a high amount of volume, it does not matter what indicator you're looking at. Actually, more or less, all the indicators will give you a very similar picture. So the idea is to not look at single category indicators, but maybe to combine mixed match of indicators from various categories. So for price action, I use chart patterns, which I have already discussed in the previous webinar. And that is what probably does the job for me. And as a confirmation tool, I look at only two indicators to filter out trades, which are RSI, which I'm going to discuss today. And the second parameter that I look at is volume, of course. So these two indicators I'll be discussing. So firstly, let's take on RSI. So the name in itself, relative strength index, is kind of a misnomer, I would say, because if you look at the name, it says relative strength index. It gives you an impression that it is maybe kind of comparing its strength to some other asset class or something. But then it is not the case. The the fact is that a relative strength index, or RSI as we call it, is relative to its own price history. So that is one thing that is to be understood. And the basic feature, or the basic objective of the indicator is to give you an idea about a stock, if it is overbought or oversold or not. So essentially, the formula of RSI looks very complicated, but at the top level, if you want to understand what is the RSI, then I would say it is just a ratio of the gain versus the losses. So it's like a gain upon gain plus loss. So it is like the gain percentage upon the total gains and the losses. So it gives you an idea how much the stock has gained over a period of time compared to the losses and the gains combined together. So this is the basic concept. And then in terms of the usage, it can be used as a momentum and also as a mean reversion indicator too. So for example, if you are buying a stock with an oversold reading, then that is like almost like a momentum trading. And if you're looking to go short on overbought stocks, then that is again like a contrarian trade. So the other thing is that it is called an oscillator. The reason being that just like any other oscillator, it oscillates between a band. So any oscillator has an upper band and a lower band. So similar to that, RSI oscillates between 0 and 100 with a midpoint of 50. So generally, the parameter that is being used to look at RSI is a 14-period RSI, and a cutoff band of 30 and 70 levels are used. So this is what probably most of you are already aware of. Now, in terms of the usage, just remember that RSI is basically a double-edged sword. I mean, what do I mean by this is that at times an overbought reading could be a sign of danger, or it could be negative or detrimental to the stock. And at times, actually an overbought reading is what you need for a momentum trade. So overbought reading does not necessarily mean negative, or it does not necessarily have a negative connotation to the stock. So this is what has to be understood, and this is where most of the people get it wrong. So I have seen a lot of people trading short on overbought stocks and buying on oversold stocks, and it's like catching a falling knife. So one has to understand the dynamics of the price action itself before you start really using RSI. So in my experience, from a practical standpoint, I do not use a 14-period and a 30-70 cutoff, because I feel it is too late to capture most of the short-term trades. So as a short-term trader, where I'm looking for a trade which is going to last for the next 4 to 5 days or maybe a week, then 14-period RSI would generally be slightly late. And of course, being a 14-period compared to a 5-period, a 14-period is always going to be slightly slower. At the same time, when you are using a shorter time period RSI like 5-period RSI, then of course it will have a lot of noise. But then if you know how to use it, then it could be really beneficial to you. And as I said, like it is a double-edged sword. So practically what I mean by this is that whenever there is a breakout, remember that RSI is going to be overbought during a breakout situation. And that's the time when you actually need to ignore the RSI reading, because if you would look at a stock which is overbought and giving a breakout, then you would probably not be able to take that trade at all. You would be thinking that the stock is overbought and the stock might not go up, but that is completely reverse, which is the reality. So in case when there is a breakout, the number has to be high. I mean, mathematically, it has to be high. It cannot be at a lower level. So that's why I said that it has to be understood in terms of the formula. So of course, when a price is giving a breakout, the reading is going to be higher. So that's when you got to ignore it. But then when there is a reasonable move after the breakout, when the trend has matured enough and probably it has achieved its technical targets, and then if you have a reading which is high on RSI, then that's the probably the point where you should be looking to really book profits. And similarly, on the short side, if you have gone short below a particular trend line, and then the stock fell down, say about 10%, and then RSI is oversold, then that is probably the point where I would actually be looking to close my short positions. And it might also happen that my targets were like 10%, but then the RSI reading is quite oversold, I'd say about 6% or about 7% of the fall. Then I would actually not wait for that 10% target of mine, and I would rather close the trade at about 6% itself. So these are the things that has to be understood, and we would actually look at the practical examples, and that will give us a better clarity. Now, in terms of the cutoff bands, I would say a reading of about 85 and 15 are to be watched for profit booking zones. So a 5-period RSI with a reading of about 85, that's when you say that it is like an overbought situation. And then on the lower side, if it is like 15, then of course it's time for you to close your short positions. Now, this is also quite effective in terms of avoiding certain suicidal trades, I would say. I mean, if the reading of RSI is on the higher side, say if it is above 90 or in the high 95 area, that means the stock is extremely overbought. And similarly, on the downside, if it is, let's say, somewhere around 5 or 6 or 7, then that's again a situation where the stock is really, really oversold. And in case if you find such a situation where the stock is giving a breakout at, say, RSI 95, then you can obviously not opt to not to take the trade. And ideally, I would suggest that you should avoid such trades. That's the only situation where you look at the RSI. If it is really, really at a very extreme end, then maybe you can find something else and not really go for that particular trade. But if it is near 80s, it is absolutely fine to go ahead with the trade. And then the other important point is that the time scale that you are looking at. So for example, if there is an RSI which is like overbought on a daily chart, and then you have an RSI which is overbought on a weekly chart, both have a different connotation. So a daily chart RSI would mean that there could be a possible correction. If you feel that there could be a correction at all, then that would last for about, say, 4 to 5 days. But then in the case of a weekly chart, if it is overbought, then the same principle would apply, but then it would be like a 4 to 5 weeks, which would be like a completely a month. So the time scale is important. And on the lower time scale, if you are looking at some hourly chart and if you find that it is overbought, then it really doesn't mean anything to you as a momentum trader for the next 4 to 5 days, because hourly charts overbought would mean that okay, maybe the stock can just do nothing for the next 1 or 2 hours, or maybe one half of the day, and that should be it. And then the again next leg of the rally would start. So it has to be understood what is the scale that you are looking at. So if you are as a momentum trader or a short-term trader, like I use daily charts mostly, and in case if I see that a stock is particularly overbought in weekly, then even if there is a breakout on the daily chart, I would prefer not to take that particular trade. Because if the higher time scale RSI says that it is really overbought, say for example, for a stock, if the weekly RSI is at about 80 or I mean at 90s, then that is really a situation where anytime the profit booking can come in. And even if there is a breakout on the daily chart, it is possible that that particular breakout might not work, because the higher time scale reading is going to dominate. So as a trader, you necessarily do not have to take a trade on the same stock. You can always go back and find some other stock where the numbers are comfortable. So the other thing that I would want to mention here is that typically RSI I use as a filter not to take the trade rather. And I would not say that you should use RSI to take contra trades. So what I mean is that if you see an overbought reading, don't go short, basically, just based on the fact that RSI is overbought. And this is the most common mistake that people do. Like in the recent times when Nifty and Bank Nifty, all the indices have moved very fast, the RSI has been overbought, I think, for a reasonable length of time now. And by looking at the overbought readings of RSI, people have shorted Nifty and Bank Nifty, and they are like some 10% away from their shorting point. So this is what can lead into a very bad situation. So trading, taking contra trades based on RSI alone is not a very good idea. So now I will give you an example of the RSI through this chart of TCS, where we can see this weekly chart of TCS, where there was a breakout at about 1350. The stock was oscillating for about quite a few months or probably years, and then there was a situation when the stock finally gave a breakout above the resistance level at this particular point, as you can see. So this is where the breakout happened. So this was somewhere around 1350 odd levels. And of course, as I mentioned, that when there is a breakout, you would see this RSI reading to be high. So the 5-period RSI on weekly chart was at 80. So if you are looking at this RSI reading alone, then you would say that it is overbought and the stock will go down. But that's not the case, because when the breakout is going to take place, I said that the reading is going to be on the higher side. And of course, this RSI is to be ignored, as I've already mentioned. So this is the reading where I am not going to pay much attention. And the stock indeed went up very quickly in the next 2-3 weeks, and it went up to about 1600 odd levels. And at this point, there was some amount of profit booking which was seen in the stock, as you can see. So this is what I'm talking about. Prices moved up to 1600, and the RSI reading was approximately at about 92, the 5-period RSI on weekly chart. So of course you would expect some amount of profit booking, or if you were long, then you would actually look to book some profit of the table. And as expected, the stock indeed corrected to the breakout area, and it again started the next leg of the rally from this particular point. And after this correction, it went up again, and it just kept on going up. And finally, the stock eventually hit an RSI of 85 plus levels at about these areas, and that is the point where I would be looking for an exit after the breakout played its part. So at this particular point, as you can see, the rally is pretty much matured. So from here to here, the rally is pretty much matured. So whatever would have been the estimates of the pattern from these lower levels, the breakout indeed played well, and that is where probably you would be looking to look at really what the RSI is saying. So this is what happened. The reading was at about 85 plus. It was close to 90, and this is where the profit booking should have been done. And as we can see in the subsequent slide, the stock did corrected heavily from 2300 levels to about 1800 levels. So that is what I was trying to highlight in the previous slides, where you ignore the RSI when there is a breakout. Remember that when the breakout is happening, the RSI reading has to be at an extreme. It would be by default at an extreme, right? So in case of a breakout, the RSI could be at about 75, or it could be 80, or it could be at about 85 as well. And similarly, on the downside, if there is a breakdown happening, then even the RSI could be at 25 or 20 odd levels, whatever be the reading. It does not matter, because in case there is a breakdown, remember that a lot of people who are trapped, they are going to be stopped out, and that is what will catapult the stock. That's one. Second, those people who are waiting for the breakout to happen or the breakdown to happen, they are going to jump in, and they will further add momentum to the stock, right? So the reading has to be read in the right context. So after the breakout, when the rally really is matured enough, that's when you look at the RSI for an exit. So in this case, as I mentioned already, that at about 2300 odd levels, the reading was really high. So here the reading was pretty much deep in the overbought zone, and this is where probably you should be looking not only to book profits, but then there are a lot of people who want to take short-term trades or quick intraday trades. So that's the point where you should be really careful. So that's what it is, that the RSI is a double-edged sword. So overbought reading at the breakout is a good thing, and then when the rally is matured, overbought reading is really something which we should be watchful, and probably it could be the time to lock in your profits. So the other indicator that I look at is the volume. And of course, volume is a very commonly used parameter to ascertain the strength of the trend or the momentum. So essentially, what is volume? Volume is nothing but just the reflection of the transaction that happens between buyers and sellers. It is simply the number of shares that are getting traded. So the theory says that volume goes with the trend. So what does it mean? It means that if there is a high amount of volume during the trend and during the breakout, that adds more confidence to the, that is kind of a confirmation that people are really going for it. So the other thing that is to be discussed about is the fact that the quantity sold is always the quantity bought, but the point is who is more aggressive. So the point here I'm trying to make is that if X amount of quantities are being bought, then the argument is that X amount of quantity has also been sold, right? So the bought and sold quantities has to be equal. So what is the significance in terms of, if someone is buying, then someone is selling. So what is in it for it? So the fact is that you have to correlate this thing with the price movement. So if the prices are going up, then that means the buyer is more aggressive. So the seller is not very aggressive because he is selling at a higher level. He is not selling cheap. He is dictating the bids, and he is asking for more prices. But it is the buyer who is convinced enough about the trend, and he is willing to take higher risk, and he is going for it, and he is chasing the prices, right? So that is why the transaction is happening, but the transaction is happening at a higher and higher prices. So that is what gives more strength to the trend, because it tells the fact that buyers are really aggressive now, and probably a follow-up activity would be seen post the breakout. But in case of a breakdown, what I have observed is that volume is always not a necessary criteria, because volume can come in later. So often I have seen some breakdowns which have worked wonderfully, and while the breakdown happened, the volume was not really very high. So it is a typical phenomenon that happens during a short trade. So the success of a short trader is basically dependent on the frustration level of the buyer. So it is when the buyer is frustrated enough, or when the buyer is kind of throwing in the towel, and when he wants to give up, that's when the stocks suddenly starts to plummet. So let's say if someone has bought a stock at 100, and if the stock has not been going up, and say if it has been moving back and forth for some time at near 100, let's say you bought the stock at this particular point, and after buying the stock, you see that the stock is not going up anywhere, and maybe there was a dip and then it has recovered. So you probably thought that the stock after buying here would straight away go here, but what you see is that the stock is not doing anything, and really even facing a selling pressure as well. So this is the point where probably you think about liquidating your stocks as a long player. So the thought process of selling does not come together to every buyer, right? So it has a cascading effect as well. So maybe the smartest of the people who are on the long side, they exit out of the trades which are not working out at the earliest, and then the next ones just follow. So what happens is after a point, maybe there was a support at this point. Let's say there was a support earlier at this point, and let's say I'm looking at this kind of a support trend line. So maybe if the stock goes down here, so this is where probably your stop loss is going to be triggered. This is the point, and that's when probably not everybody actually wants to liquidate his holdings, because it is only the professional traders who are more of systematic traders, and they would definitely be looking to liquidate. But then someone who is sophisticated, generally he would be letting the stock go at maybe these particular levels itself when the stock was not doing anything, and then he would not really wait for the stop loss to get triggered. So maybe what happens is the less informed players in the market, this is where the stock goes, and that's when they start to consider liquidating their positions, and that's when probably your volume will pick up. So this is the point where probably the volume will pick up heavily, and then this is the point where you would also find some negative news coming into the market, and everybody now wants to sell. So the point is that in case of a buy trade, the volume is, of course, which I always pay very importance. But then on the short side, I really do not wait for the volume to pick up. I go for it. If the overall conditions are fulfilling my criteria, and if the setup is good enough, I go for the short trade. So this is what is in terms of the basics. And now let's look at some live charts. I will be picking up an example of Ramco Cement, and I will show you, like we discussed already about this particular stock in terms of the pattern breakout. So you can see a descending triangle breakout on this particular stock. So now if you focus on this particular candle here, you will see that the RSI reading is already at 80. You can see the RSI reading at the bottom of my screen here. You need to focus on this number. So at this particular candle, what I'm mentioning is that just give me a moment. Yeah, so this is what I'm talking about. So my RSI reading is 80 at this particular candle, and this is where the breakout happened. So the breakout level was somewhere around 850. So if you look at the RSI, then a higher reading on RSI is like a confirmation that really the prices are moving up, and it is kind of, you know, an indication or a mechanical way of looking at the data and confirming that there is a buildup of momentum. But then next time when the stock went up even higher from these levels, from these particular candle, when the breakout happened, and then when the stock moved up to the highs of around these particular levels, so this is where the reading was pretty much in a deep overbought situation, and this is where the RSI reading came up to about 88. So this is the point where I would anyway be thinking to book my profits, even if the pattern targets are not met. So in this case, however, my pattern targets were already met, but then even the RSI also gave a confirmation that you should be looking to book profits. So now when we look at the volume aspect in this particular stock, so the breakout happened on 2nd of February 2021. And I'm going to go inside this particular candle, and I'll be flipping onto the hourly chart so that we have a better understanding. So 2nd of Feb is where the breakout happened, and just allow me to just use this particular show the trend lines. Okay, so this is the point where the breakout happened on the higher time scale, as we can see. So this is the triangle I was talking about, and this is the hourly chart. So on the hourly chart, of course, you can see from the volume part, you need to focus on the lower side here, that when the breakout actually happened on this particular candle, the volume was pretty much on the higher side in comparison to the volume that generally happened in the recent times. So the volume was, let's say, in about to the tune of about 20,000 shares in every hour, And when the breakout happened, it really picked up to about 3 times or more, and that's what gave me the confidence of the activity that is going around at this particular breakout area. So the way that I look at volume is that I do not look at the volume throughout the day. It is only at the precise breakout or the breakdown point. That's where I look at exact volume profile. That's where I totally focus on the quality of the volume that is coming in, and the amount of volume that is going in every trade, and the bids and the asks, and in every trade, literally even to the ticks. So that gives me an idea whether at the breakout point, whether the large institutions or the strong hands are also going for it or not. Because if you do not find a high volume right at the breakout point, then maybe you are the only one who is looking at the breakout and nobody else is interested in that breakout, right? So the fact that there was a high volume near the resistance trend line, and immediately after the breakout happened, the fact that the volumes were high, that gave me the confidence that the stock would actually go up, because it has been bought by strong hands. And even if there is a dip, again the strong hands would be coming back to buy even more. So that's what happened. Immediately after the breakout, it went up to, from about 850, it went up to about 880 odd levels, and then there was a mini correction which took the stock back to about 850, which is again the breakout area. And then again you can see that the volume really picked up at this particular point. So this is where the volume was really high again. So this is where the breakout was, and there was a pickup in activity in here. And then again, when the stock retraced, there was a high amount of volume. Even the following candles had a reasonable volume. So that's what actually gave me that confidence that the stock is in probably the likelihood of the stock is more to perform. So again, let me show you one more example of Escorts, which we have already discussed in the previous webinar. And similarly, with the case of Ramco Cement, again here there was a breakout on Escorts on 3rd of February. And again, I will flip to the hourly candle, and I will see where the breakout exactly took place and what was the volume profile. So approximately the breakout happened on this particular candle, as you can see. And if you look at the volume profile, the volume was already picking up when the stock was like trading just below the breakout trend line. And when the breakout took place on this particular candle here, the volume was really high. This is the volume spike here. And even on the subsequent candles, of course, there was a slight downfall in the volume, but then the overall average volume was pretty much on the higher side. So the fact is that when there is a volume at the breakout point, this will tell you whether it is being bought by the large institutions or not. So if you compare this volume with the volume during the down when the stock was drifting down, it is pretty much on the lower side. It is not as high as what it was when the stock gave a breakout. So now this I think should give you a better picture of what happened in terms of the volume. So the volume is what I am talking about here in this area. And then all this while, when the stock was going down, the volume was not very significant, as you can see. So of course this is an hourly chart, but then everything has to be looked in proportion. And even after the breakout point, the volume again went back to the normal levels. So the fact that at the breakout area there was a spike in activity, or there was a pickup in activity, is what I'm interested in. I do not look into what happened 3 days back or 10 days back, and if there was a volume back then or not. So the idea is that when a trend line is there, and when prices are hitting the trend lines, that's when everything becomes very sensitive, and that's where probably everybody is looking at that trend line, and everybody is going to take some aggressive trades. So some people would initiate fresh trades, some people would be stopped out, and some people would be looking to add more positions. So exactly the real color of the stock comes up really at the breakout area. And now if you combine this with the RSI, of course, the RSI here was at about 76, as you can see on the right bottom corner. So a reading of about 76 is a pretty healthy reading on RSI. Again, this is a 5-period RSI that you have to keep in mind. And so I'm good enough to go for this trade, and it is absolutely fine. So let's say in case if the stock was at 82 or something, like in here, the RSI reading was at about 82. So if my pattern targets are met, then probably it is anyway I'm going to be looking to book profit. But then if the RSI reading was at say about 88 or 87, even if the pattern targets would not have been achieved, I still would have looked to book my profits. So it's not very complicated. The way I look at it is just look at the raw RSI and just make sure that it is not extremely overbought. And in case if it is so, then you can skip that trade. You can find another trade. And the other thing that one has to remember is that if the stock is overbought, just don't go short because it is overbought, right? So that's a very dangerous ploy, and it really doesn't help to a momentum trader. And in terms of the volume, just make sure that you are paying the attention at the volume parameter when the trend line is getting broken. So that's when the activity is the most important, and it does not matter if at the beginning of the day if there was volume or not. So if there is a high amount of activity during the breakout area, that's what will be the main thing to be watched upon. And so now with this, I would conclude today's session, and in the next webinar, we will be looking at more into market sentiment, and we will actually try to understand the overall market dynamics. And up till while we were only concentrating on individual stocks, but we never looked into what is happening at a market-wide level. So having an idea about the whole market gives you a better understanding of your technical trade setups. So if you see that there is a lot of breakout which is taking place, and there are a lot of trades which are firing really quick, and really people are going for it, then that means it's like an healthy environment. And in the next webinar, of course, I will be discussing all of it in detail, and that will be very interesting for you to get a holistic picture. So thanks for joining today's webinar. Thank you so much.